In this week's video, we'll review the latest charts and data to help us answer the question, what does history tell us about the AI disruption narrative? Common sense tells us that if AI was going to be disruptive in a negative manner and lead to a severe economic recession and/or depression, then all of those negative consequences or negative economic outcomes would be reflected in the market's trend and in all the data tracked by the secular volatility model. And that's just not the case. Even after Thursday's week session, the scores for the secular volatility model were fine relative to the secular bull market trend and even the current trend off of the tariff news became less bad low in April of last year. And if AI were going to cause all types of negative economic outcomes, then we wouldn't expect the chart of the S&P 500 to look like it does on February 13th, 2026 at 1:40 p.m. Eastern Time. Hypothetically, even if the market backtracked to this anchored volume-weighted average price line here, this light blue line which was anchored to this peak prior to the tariff plunge in 2025, that would represent a drop from Thursday's close of approximately 7.73%. And as you can see, during Friday's session and during all of the recent volatility, we were nowhere near that line. Number one, an 8% pullback falls into the 100% normal and to be expected category. And number two, a pullback hypothetically all the way to this line here, if we held, wouldn't even put this rally off of the April 2025 low in jeopardy. And even if we did undercut this region in here, it wouldn't put the rally off of the October 2022 low in jeopardy. We would have to undercut this blue line here and the lower orange line. Now, all of that may happen in the coming weeks and months, but none of it is even close to happening in early to mid-February. Thus, the chart on your screen and the weight of the evidence don't align with the gloom and doom AI narrative. And also noteworthy relative to this topic, talk of gloom and doom and job destruction and severe recessions and depressions as it relates to innovation and technology, nothing new. Early stages of the Industrial Revolution, the narrative was machines will permanently destroy skilled textile jobs and impoverish workers. What actually happened? Some jobs did disappear. It's the way it is. However, textile production exploded, prices fell dramatically, demand increased, and total employment in textiles eventually grew. It's just the type of jobs that people did changed. Thus, rather than having machines and/or the Industrial Revolution permanently destroy jobs and impoverish workers, the real result was that the Industrial Revolution dramatically increased incomes and living standards. 1970s and 80s, calculators will destroy the jobs of accountants, bookkeepers, and financial clerks. All of them will become obsolete. What happened? Ultimately, all of these people became much more productive, and financial analysis expanded. New roles emerged, and finance grew dramatically as a sector. And in the end, jobs weren't destroyed, they were created. Productivity improved, and higher-level analytical work expanded. Personal computers in the 1980s, secretaries, typists, and clerical workers will vanish, resulting in mass unemployment. What actually happened? Some people did lose their jobs. It's not unusual. But entire new industries were formed. Software, IT services, cybersecurity. Administrative productivity soared. White-collar work expanded overall, helping fuel the 1990s productivity boom. And guess what? helping fuel a secular bull market that lasted from 1982 into the spring of the year 2000. Innovation, productivity, and secular bull markets go hand in hand. Spreadsheets, the narrative, the gloom and doom narrative. Corporate finance departments will shrink dramatically. What actually happened? Financial modeling exploded. Capital allocation became more sophisticated. Investment banking and asset management scaled massively. Spreadsheets didn't reduce financial complexity, they increased it. Another example, ATMs. The gloom and doom narrative, bank tellers will disappear. What actually happened? Tellers per branch did fall, but ATMs reduce costs, allowing banks to open more branches. Teller roles did shift from tactical duties to sales and customer service, and total teller employment actually increased for decades, resulting in more rather than fewer jobs. The internet in the 1990s, the gloom and doom narrative. Retail media, travel agencies, and publishing will collapse, resulting in systemic job destruction. What actually happened? Some industries were hurt in a negative manner. Some positions were hurt and reduced and/or eliminated. But entirely new industries emerged: e-commerce, digital marketing, cloud computing, to name a few. And the net economic effect? Strongly positive. Automated manufacturing and robotics. Probably fair to say this one's a little bit more mixed. The fear was that the industrial middle class would be wiped out permanently. And the reality is there were some significant negative consequences. But big picture-wise, it was a net positive. Manufacturing employment did fall in certain regions, but output surged, prices dropped, global supply chains expanded, and the services sector expanded massively. There was pain and there was job destruction, but big picture-wise, it was a net positive. Now, none of this is particularly new, and it's not particularly new that the gloom and doom narrative is basically driven by a scarcity mentality. There's only so many jobs out there. And if you destroy a job, they never think about the fact that for every one job you destroy, it's possible that you create one or two jobs. History shows us over and over again that innovation and productivity enhancements are a net gain for standards of living and the economy. Now back to the charts. This is the broad S&P 1500. During Friday's session, still hovering around an all-time high. There's nothing particularly alarming on this chart. Even if it backtracked all the way to this orange line here, that would represent a drop of roughly 8% from the close on Thursday, February 12th. Clients and regular viewers know 10% corrections, 11% corrections, 12% corrections, even double-digit corrections, pushing into the upper teens and into the low 20s. All of that is normal and to be expected, even within the context of a secular bull market. During Friday's session, XLK, the much maligned tech sector, up 0.89%, upper right-hand corner of your screen, and still trading above an upward sloping 200-day moving average shown in red. Relative to the trend that's currently in place, this orange line is relevant, this purple line is relevant. Price remains above the purple line, above the orange line, and above an upward sloping 200-day moving average. Keep hearing that the tech sector's in big trouble. Really not seeing any of that reflected on the chart of SMH, the semiconductor ETF, during Friday's session. It is still trading above an upward sloping 50-day moving average in blue, an upward sloping 100-day moving average shown in green, and well above an upward sloping 200-day moving average shown in red. Numerous areas of potential support below, if hypothetically it decides to backtrack, which would be 100% normal and to be expected. The last thing that it did was make a new and important higher high. It hasn't come close to making a relevant lower low at this point. As always, the commentary is based on the chart in front of us. I'm not making any assumptions about what the next 3 days or 3 weeks or even 3 months look like. Similar situation here. SPYG during the session on Friday, February 13th, above numerous and upward sloping, relevant anchored volume weighted average price lines. We have plenty of reference points below price if SPYG or any of the other large cap growth ETFs decide to backtrack. Backtracking is 100% normal and to be expected. For the longer term trend to be in jeopardy, the trend off of this low here in Q4 of 2022, we would have to undercut the red and blue lines. How about the credit markets? Are they jumping up and down, screaming imminent recession? And are they jumping up and down, screaming that inflation's about to be a major problem again? If we look at investment-grade corporate bonds, a diversified basket, this is LQD, an ETF, the answer to both of those questions are a definitive no. This is what the bond market looks like, or corporate bonds look like, when investors start to get concerned about inflation and or a recession, and when the fears of possible bond defaults start to increase. LQD in Q1 of 2022 falls rapidly from the upper left up here to the lower right down here. Recently, it's been doing just the opposite. It's been moving from the lower left down here to the upper right up here. And more importantly, the fact that LQD was able to get above this cluster of converging anchored volume weighted average price lines, the colored lines here, break above it, retest it, and then make a higher high, it's still hovering around a higher high, tells us that all of these fears back here during the bear market in 2022 have been held in check. Concerns would increase if we gave up this level here. And more importantly, if we drop below this very convincing and turning up and converging look of those important lines. This is telling us to keep an open mind about LQDA, holding this bullish breakout, keeping fears of increasing inflation at bay, and keeping fears of a recession at bay, and keeping fears of increasing corporate bond defaults at bay. This does not look like a chart or a market where market participants are concerned about those negative outcomes. How about U.S. Treasury bonds? What does the bond market look like when it starts to get concerned about inflation in particular? You really don't want to own things that you stick under your mattress like CDs or bonds or savings accounts when inflation starts to take off. And hence, that's why IEF, when inflation concerns are increasing, when the government is printing money hand over fist and filling up mailboxes with stimulus checks in 2020, why it moves from the upper left to the lower right. And it's not really a coincidence that it starts to bottom right in this region here, where the S&P 500 puts in a major bottom in October of 2022, and this is when a correction ends in October of 2023. Similar to the last chart, the fact that IEF has broken above these anchored volume weighted average price lines in this region here, has consolidated above those lines, and is now hovering around or making a new multi-year high. What does all of this mean? It means that the fears and concerns of market participants in Q1 of 2026 are significantly different relative to their fears and concerns in 2021 and 2022. The longer above these lines, the more relevant it becomes. But this is telling us to keep an open mind about inflation remaining in check, the economy potentially avoiding another problem related to inflation, and keeps the door open to the potential for either stable or lower interest rates, meaning inflation and rates potentially will not be a showstopper as they were in calendar year 2022. There's another way to look at this. You can do it on a relative basis. Now we're looking at the same two ETFs, but this time it's IEF relative to LQD. When economic fear spikes, as it did during the financial crisis, this ratio pops. This is fear here in 2008 as the S&P 500 down here is plunging. This is fear here during the COVID crash as the S&P 500 is crashing. Do we have any of that in the present day? We do not. This is a live chart, Friday, February 13th at 2:01 p.m. Eastern Time, telling us it's difficult to answer this question with anything other than not right now. Next question. Are asset allocations this simple? Sell all of your tech, sell all of your growth, and buy foreign stocks, precious metals, and industrial metals. Similar to the bond charts that we just covered, this is what the negative outcome scenario looks like for the NASDAQ relative to the S&P 500. This is calendar year 2022. Notice how the ratio or price starts to drop below the AWOP lines. And notice when things started to improve and we switch back to risk on, the ratio starts to climb above those exact same colored AWOP lines. At the point of maximum fear, the ratio is below all the lines down here, and in the present day, we're above all of those same lines, and they are clustering together and still turning up in this region. This is the NASDAQ relative to the S&P 500. So as long as the volatility and consolidation, all of it occurs above this region here, it's pretty easy to classify it as 100% normal and to be expected volatility. It gets a little bit more difficult to do that if we undercut this region here from April of 2025. But right now, the last thing this ratio did was break out in a constructive manner, and all of this consolidation, including what's been happening since October of last year, is occurring above the important demarcation level here, or these demarcation lines in this region here. So right now, it's prudent to be patient and continue to classify this as 100% normal and to be expected volatility, while keeping an open mind about this ultimately being a lower high and this being a false breakout. We don't have information in hand to support that yet, but we have to be open to that possibility. Everything that we said about the last chart applies to this chart, FTech relative to the S&P 500. This is 2022 here. This is the present day over here. Concerns would increase if the ratio moves into this region here. Now, this chart looks a little bit more vulnerable here because this is a breakout in the upper right-hand corner of your screen. And now it is looking like a failed breakout. That was an important breakout there. Having said that, we're back down now to this region of potential support in this area here, and it's prudent for us to see how it plays out. It would be easier and more prudent and logical to reduce our exposure to growth again if the ratio moves into this white space here. But for now, it's prudent to say we've made some incremental reductions in our exposure to large cap growth, and now it's prudent to see how this plays out. Similar concepts here, except for this large cap growth ETF, SPYG relative to SPY, looks a little less vulnerable and better. We've got this cluster of turning up AWOP lines here. We've got this rising trend line. You can see if we attach those AWOP lines to highs and lows, important highs and lows, dating all the way back to 2011 on the left side of your screen. The chart goes back to 2010. The ratio is currently above all of those lines. Why does that matter? Because they represent areas of possible support. And you can see it has continued to make a series of higher highs and higher lows. And we still, despite all of this give back and underperformance in here, have not dropped below any of these lines. We've not dropped below the blue upward sloping trend line, nor have we made an important lower low. Hence, it is prudent to be patient at this point and see how it unfolds and call this what it is. It's a give back right now within the context of an uptrend that resumed off of this low here. We've been in an uptrend since early 2023, late 2022. It's difficult to believe that the economy is in big trouble or the tech sector's in big trouble when the chart of SMH relative to SPY looks like this at 2:15 p.m. Eastern Time on February 13th, 2026. Should we dump all of our tech, all of our XLK, and pile into the equally weighted S&P 500 RSP just because it's in the midst of a counter trend rally? Depends what your strategy is. Under our strategy, the answer would be a definitive no. The last thing RSP relative to XLK did was make a new all-time low. Right now, this looks like a counter trend move within the context of an existing downtrend. For that to change from a probability perspective, we would need to see this ratio do a couple of things. Number one, exceed this high here from April of 2025. And number two, to get above these downward sloping AWOP lines that are above the ratio. And even if that happens, you can see this is a long-term counter trend move, we would still want to migrate to RSP in an incremental and prudent manner relative to the longer-term charts. There's no question, since October of last year, RSP has been outperforming XLK significantly. But we could have said that from this low here to this high here. But within the context of a downtrend, all of that, 100% of this outperformance in here was given back. So if you held XLK from here to here, you won. We own some RSP. It's on the books. And we're open to adding to it if the weight of the evidence aligns with that in terms of our long-term outlook. Very similar story here with gold relative to the S&P 500. Observable improvement and outperformance down in the lower right-hand corner of your screen, but a lot of hurdles remain. Hence, the very measured and incremental changes to our allocation relative to metals and precious metals. We'll see how this unfolds. This chart dates all the way back to 1968. Really, everything that we've said relative to these downtrends and countertrend moves also applies to foreign stocks, ACWX relative to SPY. A lot of good things happening in this region here. Still have hurdles to clear. Why are these relevant hurdles? Right in this window here, foreign stocks are outperforming, and this peak right here is almost the exact day that the S&P 500 bottoms, right around Christmas Eve in 2018, and foreign stocks start to underperform. And you'll notice it acts as resistance, similar situation. This is a reversal here. This is where tech started to get its act together in late 2022, early 2023. And we're still below those lines right here in the present day. It would become easier to add to our foreign exposure if we can clear these lines here, which is right down here, and if some of these lines turned up. That absolutely positively may happen. It may happen very, very soon, but it just hasn't happened yet during the session on Friday, February 13th. EUFN, one of the leaders in terms of foreign stocks doing well. A higher high in the ratio here and a lower high in momentum or RSI down here. We also have numerous forms of potential resistance in this area here. Acted as resistance here during a reversal, 2015. Acted as resistance here, the pink line, during a reversal in 2017. We went above that line, and now we're back below it with momentum moving in the wrong direction. Having said that, these lines are starting to flatten out, and if the ratio can get out into this white space, it gets a lot easier to do another incremental add to foreign stocks. A lot of good things have happened here, hence why we've added to foreign stocks, but we still need to see more. If you pause your video player here, you can see FNDF, a hot place to be, foreign stocks, relative to large cap growth, the recent dog taken out to the woodshed in the media. This still looks like a counter trend move down here within the context of an existing downtrend. The last thing it did was make a new all-time low. It has not made a significant higher high yet. This is relevant here. Clearing this high is relevant, but you've still got a lot of hurdles above here, and your ratio is still below the downward sloping AWOP lines that have acted as resistance in the past. So if you're approaching a line that's acted as resistance in the past, it is prudent to slow down and see how things go. If the ratio moves into this region here or starts to clear some of these hurdles, it gets easier to do another incremental add to our foreign exposure. But these are the facts that we have in hand right now, and they align with the measured approach, way of thinking and executing. Similar situation here. Should we dump all of our tech and pile into foreign stocks because they've been outperforming recently? This chart says no. This chart says you better slow down and respect the fact that we're in a bull market. And in a bull market, if it's ongoing, XLK will probably continue to go up, and FNDF will probably continue to go up. And thus, we would prefer not to overtrade in a bull market. What once acted as resistance may act as resistance again. This is another important reversal point. This is that Christmas Eve low in the S&P 500 where this leadership in foreign stocks reversed abruptly. Right here during the bear market in 2022, FNDF outperformed. That outperformance reversed abruptly and was given back. All of it was given back. So between here and here, relative to this question, should I sell XLK and buy FNDF? We would be in no particular rush, especially to do anything other than small incremental shifts. Similar situation here. This is XLK relative to SPY. Numerous reference points. What once acted as resistance, may now act as support. And that is exactly where these AWOP lines come into play, right here. And that's exactly where this upward sloping trend line, the current uptrend, the last thing it did was make a new high. Hasn't made a significant lower low. You would have to undercut this low for that to happen. So we're in an uptrend off of this Q1, Q4 2022, Q1 2023 bottoming process where tech started to outperform again. We couldn't clear this level here before the bear market, and we had trouble with these colored lines. Right now, we're well above those same colored lines, and it's prudent for us to see if what once acted as resistance, if that may now act as support if we shoot down into this region. And right now, we've come back and tagged this orange line here that's tied to the major low. So it's really easy to slow down on this process if we can hold this. And it's also prudent to take a measured approach if this relative chart can hold above this region here. We're not making any assumptions about how that plays out. This is a pretty sharp reversal, but we've had sharp reversals in the past that eventually were followed by higher highs. Most of the charts that we used in this week's video were used in a video months ago. And that's relevant because they're still providing a bias to the upside and a bias to remain patient and a bias to respect 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends, including 10% pullbacks. They happen from time to time. Remaining patient aligns with the weight of the evidence. And we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.